Fittingly, the S&P 500 finished off this week with a very strong move, a very strong week, and a very strong, really 4 weeks, beginning of the year, very strong month. So I'm gonna break down kind of how strong this is, whether what that means in terms of pullbacks, what to expect from the pullbacks. I started to break that down yesterday. I'm gonna go over that a little bit more tonight. I'm also gonna break down the moves that kind of re-engage today, and what can lead the way during the bullish moves up and what can pull back, and where we might be able to find some areas of value, some opportunity. So let's go ahead and get started. Today is Friday, January the 26th, 2018. This is the Market Outlook from MarketScholars.com. My name is David Settle. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Glad you found us. Keep coming back for more. Subscribe to my YouTube channel by clicking that red subscribe button right down below the video there. While you're down there, click the thumbs up icon. That lets me know two things. Number one, that you liked tonight's video, you got something out of it. Number two, that you want me to do it again on Monday. One click, really easy way to give me feedback on what you're thinking there. Comment on anything that you learned or anything that stood out to you from today's video. Scroll down to the bottom even further. You'll see the comment section down there. Join my daily email newsletter, my daily email list that I send out every day, every night. The Market Outlook tweet, time-stamped, hyperlink summary of everything we talk about in these videos. Also follow me on Twitter for more content in addition to these videos. You see my handle on the screen there. Remember to like and retweet my Market Outlook tweets to make sure that Twitter keeps pushing you all of my tweets. And finally, join the Market Outlook community. There's about over 800 of us here. You see the address. It's on Facebook. Go to that address. There's a link down in the description as well. Click on that link, takes you straight there. You can join there. All right, let's take a look at the S&P first then with the market forecast indicator. You can see that near-term line pulled back. We said yesterday, that maybe this was that as much of the near-term pullback as we were going to get, because if you recall, the Nasdaq and the Russell had both brought their near-term lines below 50. Maybe that was it. In this case, it was so weak that the S&P's near-term line never did drop below 50. But we also said too that if we do bounce up off of this, and we happen to bounce up to new highs, look for divergences. We've had such a strong run. This peak here was so high in the near-term line that it's going to be hard, not impossible, because right now nothing is impossible, but hard to replicate that kind of a peak, which almost sets it up for an automatic divergence, especially considering that we're obviously already much higher than that near-term high. And of course, the low point in between, in this case about 28.25, the 23% Fibonacci retracement would be the target for the next near-term pullback. Now, we also said too, don't expect big near-term pullbacks. Yes, we've had a big near-term run, but when we are this far up above moving averages, we typically just don't get strong near-term pullbacks. We typically will get more of them. We'll get a higher frequency. We'll start to get more ovals like we did here as we kind of grind sideways and the near-term and the moving average catches up, but nothing significant, right? And so yeah, I mean, that wouldn't be too significant. Now it's 50 some odd points, 55 or 45 points to get down to that point from here, and that seems significant, but in reality, considering you're up almost 200 points on the S&P 500 year to date, would not be that big of a move whatsoever. So that's kind of what we're getting. The posture is still strongly bullish, has been now for months. We are now 5 months into this bullish posture. That's, that we're going on half a year of the intermediate line being above 50. That's a long, long time. You'd have to go back really far to see the last time that we didn't get at least something like that near to an intermediate pullback that brought the intermediate line down below 50. Very, very, very long time coming. And in the intermediate posture, the market sentiment line crossed up above 80. Again, you have to go back pretty far to not find a move this big after the market sentiment crossed above 80. So you can see about right here, this would be 1024. So where's 1024? Right there. So from that date up till now, you can see we're almost 12% gain since the market sentiment line crossed above 80. That's a 54% annualized return over the course of this 94-day period. Strong rally. That's a strong rally that, again, is typically don't get from this technical setup. And if you recall it, we were already, the market sentiment was already, just barely below 70. So we were, a month and a half in, and that was kind of about what we were expecting for the intermediate run because of how high market sentiment already was. So obviously this was longer than expected. The Posh has been bullish, so it hasn't been doing anything different than what's expected from that perspective. From following the trend, the only thing that has been unexpected is the length and how big it's been, how big the move has been. But the trend has still been bullish, and so that's why we still need to always maintain. A lot of our trade ideas have been bullish. A lot of them been doing, just everything has been doing really well. A lot of the trade ideas we talked about here in these videos over the last few months. If you've been following me on Twitter, following Brandon Van Zee on Twitter, he's been highlighting a lot of his trade ideas from this past year when he's been teaching his old classes, still keeping track of the portfolios that he taught in those classes that we will start teaching here again really soon. He started teaching that income investing and trend trading class really soon. A lot of those trade examples that he used in those classes have been doing very, very well, have been kind of accelerating their gains here, which kind of goes to show that, what people might think is like a boring way of trading, not just investing, but just trading, buying stocks and holding them for a longer period of time. Right now, no one's complaining about how long they've held a lot of those positions because they are paying off. When the market moves like this, when the market kind of moves irrationally, as long as you're following the trend, then your portfolio should be looking pretty irrational right now too, and that's a good thing. But we are getting to the point from a valuation standpoint and all these other technical perspectives. We are getting to the point where we're walking a tightrope between between the twin towers. And so when we are getting that high, we have to manage risk. We have to say, okay, what's going to happen when we're not expecting a big pullback. We're expecting it to grind, but we didn't expect this either. So we have to prepare for the unexpected. One great quote, and again, a reminder here, follow me on Twitter for content I put out there throughout the day, and make sure that Twitter keeps pushing you my content by liking it, liking and retweeting. Really easy to do it for the Market Outlook videos, night in and night out. They're always pinned to the top, and we're shooting to get that number here. We've gotten up to 120 before. We're shooting to get that up to 150. So you'll always find it pinned to the top. But this quote right here, when we are, trying to get the market to do something, whether it's go up or go down, right? When we're trying to get the market to do something, then we know, in this case, our ego is probably involved. Emotions, things that aren't technical and mechanical are involved. We simply, like he says here, better to let the markets do what it wants to do and simply observe and adjust as needed. And the market has been wanting to go up for a very long extended period of time. And now granted, there might be some people that thought, well, it's gone up too much, I'll start to fade this and go bearish. Now we need it to go down. We should never need the market to do anything or want it really to do anything. We should observe it like we do on these videos, night in and night out, and then adjust and observe and adjust accordingly. Great quote there. I wanted to make sure that you all knew, and basically it's kind of a theme of these videos and why we look at them night in and night out, so that we can continually observe, and then I teach you how to manage and adjust portfolios and position and risk management, so that we can just kind of follow and do what the market gives us. I'm a basketball coach in my spare time, and a very common thing that you teach players is don't force anything. Right, we should never force anything and just take what the defense gives us. If the defense is giving us this play or that play or this kind of move or that kind of move, then instead of forcing what we want to do, we say, okay, well, let's just take what they give us until they stop, and then we'll adjust, observe, and adjust accordingly. All right, really quickly, I didn't look at the other indexes, but they all look very similar to the Dow. You can see the Dow looks very similar to the S&P 500, another all-time high. Remember, the Nasdaq had its near-term line pull back below 50, and that was the extent of the pullback. They are expected, the near-term pullbacks are expected to be weaker, and we talked about that last night when we are this bullish. And again, like the Russell 2002, that's as bullish as it got, or as much of a pullback as we got. But you notice we got a couple kind of back-to-back here. So we are going to start to get more of these weaker pullbacks, near-term pullbacks, and start to go up and down, while these longer-term moving averages that are almost parabolic start to catch up and flatten out in the other direction, right? They're parabolic right now. Well, this way for you, parabolic right now. Well, eventually they have to go from doing this, where the curve is down like that, kind of a bowl, to doing this, where the curve is on the other side now, right? For you calculus, you know exactly what I'm talking about. My limited exposure to calculus has been eons ago. These are the last 4 weeks. You can see since the beginning of the year, you can see just how bullish they've been. If I look at this moving average, or the MACD down here, and look at it, current prices compared to that 50-day moving average, we were pretty high already, up above the moving average that last week in December. A little bit of a pullback, remember, on that last day of the year. That brought the MACD down, brought it closer to the 50-day moving average, a little less than 50 points. And then now we have just about tripled, almost tripled. Well, we've gone from 44 up to 141, so we have tripled the distance that we are. Even though the moving average itself has risen, the moving average itself has gone from, 2629 to 2629 to 2730. So the moving average itself, the 50-day moving average, has gone up 100 points in this 4 weeks. But the index itself, like we said, has gone from 2673 up to, it's gone up 200 points. So quite the move. Again, a 44-point gap initially, and now a 142-point gap now. So sharp move, very, very high. Needless to say, right? Very, very high up above. Strong gap. But that, again, that one day, again, probably shouldn't have been, that shouldn't have been a red candle, because it was kind of an odd end of year, last day of the year pullback that was relatively large compared to the rest of the days around the holiday. So it probably should have ended up like right around there. So we might have been 10 weeks in a row here of going to the upside, because we had a strong rally heading into through Thanksgiving and into Christmas. And again, from a seasonality standpoint, there generally is some weakness in January, not with this tax reform. And this is all tax reform related, and it's been really providing a lift to equities. And of course, remember, again, when you get this high, the MACD never stays high, so the MACD will pull back. But you notice it never pulls back in a straight line. It does move up very, very quickly, usually off of lows, and that's what's so surprising about how big this move has been, because it's not like we never get these moves ever, but we usually get them off of lows, right? Like at this move here, and you can see, if I were to replicate, this line, like for example, this one right here, if I were to replicate that move over a 4-week time frame right there, and just duplicate that and move it over here, because you see the line will get steeper because of the log. You can see, so there it is. We were on pace, and then this week has really pushed it up even faster than that line. But you can see that's the type of move that we're getting now, is that move that we had. Similar to these moves coming off of lows below. And you can see this one too, big move, very, very sharp move here, coming off of that low point over a 4-week period of time. If I were to duplicate that one and bring it over, and maybe this is the one I was thinking about before, very similar move. So very similar, even as bullish as that one was back at the beginning of 2016 over 4 weeks, this has been even more bullish. Because again, remember, this is a log chart, so this has been even more bullish than that one. And again, that was coming off a really deep and a bullish divergence too, but a really deep, about 100 points below the 50-day moving average, which we had never been 100 points above it that time. So it was a sharp move to the downside, long lower shadows, which are always bullish, and then a sharp rally over 4 weeks. So not surprising to get this kind of move. This isn't unprecedented, but it's not typical for when we're already 50 points up above, which again makes this concept. Now you notice back here we didn't go down after that sharp move. We started to grind. We started to move, kind of sideways. And all these times that we were, more than 50 points above, we never really. This is about as sharp of a dive that we got here. All the other times have been more gradual moves. And that was, closer to the 200-day moving average. The gap was a lot smaller there. The gap between the 50 and 200-day moving average now is bigger than it's ever been on a relative basis, on an absolute basis, and now on a relative basis. When you look at the 3 green arrows, again, the same concept applies. When the MACD gets this high, we typically don't take a steep dive. We will gradually move lower. Now, we've never been this high on an absolute basis, which means when we've, all these other times when we've gradually moved to form an intermediate low point, it's taken weeks. So, again, it could be weeks to a couple of months before we finally get to the point where these moving averages here converge and get this MACD down to zero. It gets down to zero when the lines converge. It could be a long, long time. So you don't want to be in the mode where you need the market to go down. I know that there's a lot of people out there, that always kind of talk, I just need the market to go down. I need them to know. It's not. It's going to converge, and it's going to take weeks for it to converge, most likely. Now, granted, it could tank. Who knows if Trump gets impeached or whatever, and who knows what can happen that can cause a black swan sudden dive 1987 style, right? But aside from that, it's going to be a slow grind, a slow grind as these lines converge. And again, it goes from parabolic to the other way, right, where it slopes out that way now, and the lines all converge to each other. All right, so now we see again the 4-week range. We'll take a look at the 2-week range. You can see today's move: higher high, higher low, low at the beginning of the day after a gap up, high at the very end of the day, very end of the week. As bullish of a candle as you could possibly get, as bullish of a week practically as you could possibly. The low of the week was right at the smack dab at the open, and we rallied up off of that, and then the high of the week was right smack dab at the close. So about as bullish of a candle as you can possibly get. Higher high, higher low, much higher than last week's high. The 4-week high continues to push. In fact, I haven't seen the 4-week high, the times I've been observing this with these videos for the past few years. I haven't seen it this large during an intermediate rally when the market sentiment line's this high. Usually we start to grind, and we will at some point in time. This, next week we'll start to move this up and start to move, close this gap, because we'll stop pushing high and we'll pull down into this top half, which again, we're 20 points wide. So that this 277 level is going to act. So we can trade anywhere in here and just be fine. Just grind in that top half of the chart while this starts to work its way up and start to shrink that width there of the 4-week range, and now we start trading in the lower half of that. Until then, we're just kind of in this mode, and there's the near-term pullback. And again, we can pull back to 282 here. If we pull back to 282, that would simply be a 23% Fibonacci retracement of the near-term rally, of just the near-term rally that we've had over 18 trading sessions now, because we've never had a significant enough of a pullback here. That's about as much as we had right there to bring the near-term line down below 50. Volume was really weak for most of the day until the very end, and by the end of the day, like I said, we had we ended up with a 2.67 point range. But remember, there's a gap. We closed at 283.30. The low was at 283.96, so about 2/3 of a point gap. You add that on, so we're like over 3.25 points range, including the gap here. What's from 283.30 to the high today, 283.30. And the high today was 283.63. So yeah, 3.25 point gap with over 100 million shares traded. Put that in context here. That's way up above here. And again, that's typical. When these lines are rising, it's typically bullish or bearish, not bullish. And that's why I say these lines, when they fall back down, and they will because it oscillates, usually it means that we're grinding, and we'll start to go sideways here. But yeah, the lines are rising. The volume is up above that average, up above the 52-week range. In fact, even volatility, the VIX, as much as it pulled back here. Let's move this. Now we duplicate that and put it. We have a new one here. So again, if I were to take a look at, in fact, one of the things I tweeted out today earlier was this idea that, how bullish we've been right here. This one, as bullish we've been. This was this morning, so things changed by the end of the day. But since 1-3, so since this point here, since 1-3, when we hit that lowest point on volatility, at just a little bit over 9. By the end of the day, we closed at 905, 905 there. So we're up to 1108. So that means volatility is up 1108 divided by 905. Volatility is up over 22%. Volatility is up 22%. Obviously, the S&P 500 is up since that time frame. Let's go to this chart. Actually, let me move this over and come back over here, and you can see eventually. There we go. So the S&P is right here. It's up. The second number from the left up at the top, almost 6%. So the S&P is up 6%. Volatility is up 22%. You can see on this one, since 1-3 right here, right there, average volume is obviously much higher. It was 81 million. Now it's 80. The average volume is almost 90 million. The trading range on 1-3 was 1.5 points over there on the left. Now it's 2 points. So everything is higher. Volumes, trading ranges, volatility. Usually those things, when they're higher, leads to downward markets. We're not only up, but we're up, like I said, almost 6%, which over that amount of time is almost 150% annualized return. And just to kind of show you what it means, and I tweeted it out, but to show you what it means when you have that high of a volatility chain. If you were to look 30 days out, which is what the VIX measures, 30 days out, and buy the at-the-money straddle. Now, the VIX usually looks at the puts, but I just want to show you kind of the cost of this at-the-money straddle. And you can see that the 35 put's $20. That's how much it costs right now for the 35 put. The straddle here costs $30, about $61.50. $30 plus 31 to buy both the call and the put at the money. $61.50. And remember, the delta, the out of the money put 35 delta, we're looking at about a $20 cost. If I were to go back in time to 1-3 and buy the at the money, instead of $61, you notice it only costs about $42. So same amount of time at the money, just like now, but we've gone from a cost of $42, which is the expected range over that 30 days. That's what the at the money straddle is telling us. That's what the market's telling us. The expected range has gone from 42 points to 61 points. So the market's expecting, it's been more volatile since 1-3. Now we're expecting bigger moves, which, like I said, upside and downside. So the ranges are going to start to get bigger because of how volatile, the VIX is higher, 20% higher. So the market's expecting a 61-point move now over the next 30 days. On 1-3, it was expecting a 42-point move over, range, over the next 30 days. And the 35 put, which costs $20 now, only costs $14 then. A 30 days out at 35 delta, the cost has gone up $6. $6. Nothing else changes. The strike price is the same, 35 delta. The time to expiration is the same. But because volatility is up, the cost of that put is up. So you see how the cost of protection for any positions, if you were to buy puts, starts to go up. $20 over $14.60. I mean, it doesn't seem like a lot, but that's a 37% gain just from the rise in volatility, nothing else. So it can start to get expensive. The market's expecting more volatility, and it's raising the cost of protection because of that. So remember how yesterday, how we started to get a bit of a, all the best performing asset classes pull back a little bit, the worst ones bounced up. Same thing from a sector standpoint. So we know when there is a pullback, what's going to happen, what's going to lead the way to the downside. But again, today wasn't the start of that. It wasn't a continuation of that pullback. So you can see as we renew ourselves to the upside, what's leading the way again is the dollar to the downside along with bond prices. So yields up. Same thing we've seen before, and with dollar down, you have international stocks outpacing, you have large caps outpacing small caps, you have crude oil and gold. Gold not so much today, but gold outpacing high yield, but you have crude oil doing well again. So if I were to zoom back out, you can see over that 20-day period or 10-day period, but look over the 20-day period now, which is mostly a few days in the end of 2017, but most of it's year to date. And you can see, those are the things that are going to pull back, not start a bearish trend, but pull back when the market starts to get more near-term volatility. And of course, the dollar. I mentioned yesterday, don't buy. Yesterday's move to the upside wasn't a change in trend for the dollar; it was just a bounce back. The dollar remains really weak, and bond prices remain very pressured. Because of that, the yields continuing to follow stocks up, but the gap between large caps and small caps are rising, and that's not the most bullish pattern when you see that. But from a dividend income perspective, that's really good because those are the stocks typically that are in the large cap sector, and the more higher beta, more volatile names in the small cap area don't do as well. Some names in the large cap momentum area that have done well, and Netflix has been doing really well. We've looked at that for an example. Like I mentioned, Pfizer, Halliburton, a lot of these stocks we've been looking at. Alibaba has had some pretty decent moves lately. A lot of these we've looked. GWW is Brandon highlighted in his class, and AbbVie is another one he highlighted today. Another class example he's had over this past year. That's been doing very well over the last few days. So a lot of those large cap names are paying off. Your patience in them has been paying off over this so far year to date. The big news today was the GDP number. The GDP number came in below estimates, but that's not as bad as it seemed. And I retweeted out what I mean about that. The odds of a rate hike in March pulled back a little bit for one rate hike in March, but not because we are not expecting a rate hike, because that actually fell down. The odds of a 2 rate hikes by March rallied just a little bit, not too much, but this kind of shows again the market's expecting 1 rate hike by March, and if we take a look at June, you can see the odds of 2 rate hikes by June pulled back just a smidgen, but again, it's because the odds of 3 rate hikes by June pulled up a little bit. So the odds of the 2nd rate hike in June are getting higher. And again, for that 3rd rate hike, whether it's going to be September or December, you can see that the odds of one in September are still very, very high. The odds of only having 2, you can see the odds of having a 4th one by September moved up a little bit. So, the markets, even though the economic surprise index has been pulling down because the headline figure didn't match estimates. The reason why the headline figure didn't match estimates is because of the trade balance, the negative trade balance working against the headline GDP, which is typical because we are net exporting or net importing country. So that's going to work against GDP always, most of the time. But inventories also worked against it. And when you take out the inventories and the trade effect from the GDP number, I think I retweeted out that, where was that one? Well, maybe I didn't retweet that one out. Oh, there it is. When you take that number out, the GDP was actually plus 4.3%. So consumer spending was very strong and investment was strong. Heading into, again, with the tax reform coming at the end of the quarter, investment in businesses and residential construction, which is the leading leading part of the real estate components when you look at commercial real estate as well. That residential construction, very, very strong. So very strong numbers for the last quarter of the year. So yeah, the headline figure came in below estimates, so it brought this number down, but very strong economic growth is actually starting to raise the odds of another rate hike. So potentially 4 by September. Now, most likely only 3, but the odds of getting the 4th one by December continue just to move up. So there you can see, we're getting higher and higher odds of all of these rate hikes. 3, definitely 3, if not 4 by the end of the year. You can also see from a sector standpoint, the rich keep getting richer here as well. The healthcare and consumer discretionary, which have been recent leaders, are now the strongest leaders. And over the last 4 weeks, again, most of 2018. Now, real estate and utilities continue to slowly work their way higher again. Not as much gains as they've had over the last couple of days, but those are your big winners. Healthcare, AbbVie, right, and as well as consumer discretionary, Netflix, Alibaba, those kinds of stocks, Pfizer, all those stocks doing very, very well. Technology's up there too. There's the broad market, and some of these other winners, materials, industrials, and energy. You can see now they're all actually lagging. They're still doing well, but they're lagging the market over this 4-week time frame. So they're starting to get back. The others had already given back some gains, materials, industrials, but energy now giving back some gains. And these safe haven areas, which have been underperforming so much. I mean, shoot, you look at the this chart. Yes, we'll look at that chart. Let's take a look at the ratio chart here of XLY to XLP on this weekly chart. Oops, sorry. XLY to XLP. Look at that. I mean, it's kind of, like I said, it's gone kind of parabolic there. You're going to find some opportunity for value in some of these kind of beaten up areas of utilities and real estate, which have been getting those oversold clusters. If you've been getting that emails, you can see all those clusters. They've been on the list day after day after day. So they're going to have opportunities. And then, of course, consumer staples, which has been underperforming really since the middle of 2016. Consumer discretionary, they're going to have opportunity. In fact, if you take a look at consumer staples relative to the broad market as a whole, you can see since the middle of 2016, really, really underperforming. You look at utilities, it's been a little bit more recent, since middle of 2016 too, but really taking a dive here. And then, of course, the real estate area, which is not as much of a history, but again, middle of 2016, but really kind of taking a dive now. So we know what happened in the middle of 2016. Yields took off, and those safe haven areas really started to lag and underperform. And with this week breaking up above 2.6% last week and holding it this week instead of coming right back down, that's going to put this 3% as a target. If we continue to move our way higher, maybe not in parabolic moves, but if we continue to move our way higher, that's going to continue to put pressure on those areas. But as we bounce, as we start to pull back some of these gains, we know where there's going to be some opportunity for value, at least in the short term. All right, so with our trade example today, we'll take a look at a stock. In this case, it looks like it's been on a nice sideways action. This is Eli Lilly. Now, I kind of want to stick with the theme of looking for value. Eli Lilly, when you compare Eli Lilly to the broad market as a whole, and you look at it over a long period of time, it's been lagging behind really. After peaking the week of September the 14th, 2015. So let's clear all these studies here and look at September the 14th, 2015. We'll do a comparison with Eli Lilly here. And what was it, September 14th? Right there. So from that period on, we have the market has gone up, what would that be, about 54% over that time frame, and Eli Lilly is only up 5%. So it's been, it has not been participating as much in this nice strong multi-year rally, and really since the election here, this is the election where the stock market itself has gone up as much as it has. It's gone up over 40%. Eli Lilly's been lagging behind without nearly as much of a gain. All right, so let's go back to the chart. So it's been, there's an opportunity for value, and you can see today, Pfizer, it's a stock we've looked at before, and it's really taken off today. But you look at Lilly, same thing, 3 green arrows. If you take a look at its, MACD is about to cross up above 0, stochastic's crossing up above 50. You look at its market forecast chart, intermediate line has possibility of crossing up above its midpoint. You look at the Bollinger Bands. We'll take a look at Bollinger Bands for Eli Lilly. You can see we're right up against that upper Bollinger Band there. So there's opportunity here. It looks sideways, but with this earnings coming out and with this 3 green arrows, it's got the potential for making a move. We talked yesterday about how to, we were looking at a stock that had a potential really of going one way or the other for solar. We looked at opportunities there, one of them being to do a debit spread. See, this has earnings coming out and the possibility for volatility to drop. So if we buy a call option, we're going to be susceptible to that drop in volatility. So if we also sell a call option, in this case, if I go out of the money on that long call, so below 40 in the delta, and then sell an out of the money call up above that, so 92.5, that's pretty far out there. But remember, there's earnings coming up. And this thing has made a move, and you've got, between now and March. Here, the stock has got potential within 1 standard deviation of getting up above over 93. So we're looking at 92.5. We're looking at potential reward here of $200 for a cost of 50. So a 4-to-1 reward to risk ratio if this 3 green arrows spike in volume with earnings coming up has a potential of pushing and getting that up higher. Especially with the value opportunity that's in a stock like this that hasn't been participating. And now there might, as we see, healthcare is one of the leading sectors. This has definitely not been one of the leading stocks. So there's opportunity here for some momentum and growth. Again, not expecting the market to tank, but to kind of go from this kind of a move, parabolic move, to that kind of a move. So to summarize, the market continues to follow this trend, this bullish trend, obviously longer than expected and more than expected, but still, not unexpectedly in a different direction than what the trend has been dictating. And as we said at the beginning of the video, we take what the market gives us and we observe and adjust, not trying to get the market to do what we want, because that's, obviously a lot of ego in that, because there's a lot more participants in the market than just us, but we see what it's doing and we adjust, and that's the purpose of these videos that we do day in and day out. So that being said, as always, thank you very much for watching, because I know a lot of you watch every day and I appreciate that. Remember to subscribe if you haven't already, like and comment on the video down below. Follow me on Twitter for more content with my handle. You can see a link in the description down below too. Also down there, there's a link to join the Market Outlook community on Facebook. Over 800 strong now, so join us there. Have a great evening, great weekend, everybody. We'll see you all on Monday.